So it started. The conflict between Russia and the Ukraine is finally here, and it feels unreal. I can't believe we're having a conflict in the year 2022. This doesn't feel like it should be happening this far into history, but here we are again. My dad is actually from Ukraine. He was born in Donbass, and he lives luckily here in the US with us, but he's from the region where all of this started. And I just got off the phone with him and just talked to him and got his perspective. And of course, he stands behind the people of Ukraine. I do too. My heart goes out to them, and this is a tragic circumstance. So I wasn't actually even planning on making a video today. I wish I could be happier in today's video. Unfortunately, it's hard to be happy in times like this. So in today's video, I still wanted to address what's been going on, what's happened to stocks, what's happened to crypto, and what's going to happen, especially to the Federal Reserve's decision to increase the interest rates, whether they will or they won't. And then, most importantly, I want to give some words of encouragement and reminders to investors about what happens during times like this, and hopefully shed some light on an otherwise very tragic circumstance. So let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well, and I wanted to start the video with a level-headed perspective about what's going on, because if you felt bad recently about losing money in the stock market or in crypto or NFTs, whatever it might be, please remember that there are some people around the world right now that are suffering and potentially losing their life, which makes losing money trivial by comparison. Now, my prayers and thoughts go out to the people of Ukraine, but my take is that it's the innocent people right now that are going to end up losing the most. And that's true for the people of Ukraine, for the people of Russia, and the people of the US. Here's how. In 2015, I remember visiting my grandparents in Russia, and I was blown away by how far a $100 bill got me. Because in 2014, the exchange rate was 80 rubles to the dollar. Now, that $100 bill could have comfortably afforded me a lifestyle for 1 to 2 weeks without breaking a sweat. And I remember my uncle, who's living in Russia still, was blown away by how far that $100 bill got me. But he was telling me just how expensive life was becoming for him. Everyday things from food to shelter to necessities were becoming unbearably expensive. And right now that is going to get even worse, because right now the foreign exchange rate is closer to 90 rubles on the dollar, which makes that situation even worse. Now, if you're somebody who is living in Russia, by the way, and you have access to dollars or some stable currency, then consider moving some of your money to that, because the sanctions that have been placed on Russia are only going to make the situation worse. And of course, those sanctions are cutting off foreign currency support by other countries, cutting off their major and central bank support from the European central banking system. All of that stuff is going to affect Russia in a big, big way. And the idea behind sanctions is actually really interesting, because the idea is if you can squeeze the people of a nation and make it difficult for them to live their life, then hopefully it also encourages them to remove the people in power. Hopefully it changes their strategy. But the unfortunate reality is that this is not the idea of the Russian people. If you look at people in St. Petersburg, in Moscow, they're all protesting against this invasion. They are not in support of this idea. This is not the plan of the people. This is not something that the Russian people are in support of. This is all the idea of one man who has been drunk on power for far too long, who wants to go back to the glory days of the past of the Soviet Union. And overall, it's just a shame to see everybody suffer on all sides, including the US, because we're gonna have to spend more money to support other countries. And that means more inflation. And that means we have to pay higher prices too. So with that out of the way, let's talk about how all of this is going to affect investors. The first thing that's hugely affected by times of conflict are commodity prices, which are things like oil and gold. Now, full disclosure, I do not buy or invest in gold. It's not my thing, but gold has typically done really well for investors in times like this. On Wednesday, for example, gold was up 2%. On Thursday, at the time I'm recording this video, it was up over 1%, and by Friday, it could be up even more, over $2,000. It just depends on how much this conflict escalates. Now, this has also been true throughout history as well. For example, in 1978, there was the Iranian Revolution, and gold that year was up 37%. It's crazy. And then next year, in 1979, there was the invasion of Afghanistan by the Soviet Union. And then there was also the Iranian hostage crisis. That year, in 1979, gold was up 126%. It's insane. Now, I'm not saying that gold is going to be up double or triple digits this year. It really depends on how much people get scared and how much this conflict escalates. Now, the simple explanation behind why gold goes up in value so much in times of conflict is because conflict produces more government spending. And even though the US is not in direct conflict with Russia, it still is supporting Ukraine and it's paying more money. And this government spending at least has the effect of perceived inflation. And as we perceive inflation to go up, investors put their money into inflation hedge assets, which traditionally the best one has been gold. And Bitcoin, of course. So that's how that works. The second commodity that is hugely affected in times of conflict is, of course, oil, which is now most likely more than $100 per barrel. And that means in the next few days, if not the next few weeks, the price of gas will more than likely go up to over $5 a gallon. It's already like that in California, and it's probably going to continue to go up, which is crazy expensive. And just for context, the last time that oil was this expensive was in 2014, and that's exactly when I started to buy into the energy sector. That's right around the time that I was discovering the dividend passive income strategy, and one of the cornerstone pieces of advice from the community at that time was to diversify your income into the energy sector. So I bought in. And these are stocks like BP and Shell Oil, Chevron, ExxonMobil. And one of the things that it had going for it at the time was that their dividend yield was incredibly high. And the most important thing was that these companies have paid their shareholders dividends nonstop without missing a single payment, which is insane. No matter what global conflict has gone on, these companies have always paid their shareholders money. And that made me confident, which is why I bought in. But over the last 7 years, they've dragged down my performance because they didn't really do that well. Luckily, I never sold. I kept them because I was being paid dividends, which was my incentive to hold on. But now those stocks are finally starting to recover, which is the upside. The downside is that oil is becoming more expensive, which means everyday life is also becoming more expensive. Then there was also the tech sector, and this one really surprised me because the Dow Jones on Wednesday fell by 1.5%, and the tech-heavy Nasdaq fell over 3%. But the thing that surprised me the most was crypto. Bitcoin, for example, was down over 5% on Wednesday, which is really amazing when you compare it to a stock like Tesla, which also on Wednesday was down over 7%. Not to mention Redfin, which was down over 9%, which is worse than Ethereum's 8%. So the question is, how are these tech stocks more volatile than crypto? Isn't crypto supposed to be the crazy one? And the answer is yes and no. The reason that crypto prices, and by the way, when I say crypto, I mean mostly Bitcoin, the reason they're more stable than some tech stocks is mostly because the negative news is already priced into Bitcoin. In other words, we already know all there is to know about the negative things that's going to happen to Bitcoin. We know that the spot ETF was rejected, and it's probably not going to happen for a little while. We also know that regulations are coming. So we know the bad news, which means Bitcoin is a little bit more accurately priced in. But when it comes to stocks, for example, some companies, especially tech, rely on cheap debt for expansion, which means if you increase the cost to borrow money, then it slows down their growth rate, which means it could take a few years before they become profitable or are able to borrow cheap money again. And because of this conflict, these interest rates by the Federal Reserve are up in the air again. We don't know what's going to happen to interest rates, which is why tech stocks are becoming more volatile. Speaking of interest rates though, as of right now, Goldman Sachs estimates that there's a shortage of 4.6 million people from the labor force, which means companies have to incentivize people by paying them more, increase their wage. But when you do that, you increase the odds of the wage price spiral. And this is when you increase people's wages, you as a company will probably pass on those costs to your consumers by charging them more money. But that also contributes to inflation, which means, guess what? You have to pay people more money. As you pay people more money, you gotta pass on those costs to your consumers by charging them more money, contributing to inflation. Guess what? Pay people more money. And it's a vicious cycle of back and forth, and that is not the place we want to be. Now, all of this really depends on aggregate demand. if this conflict scares consumers and we start saving money and we stop spending, then I could see the Fed slow down on interest rate increases or maybe not increasing them as much. But if demand still stays high and we're still spending money regardless, then the Fed will still step in and increase those rates in March, regardless of what conflict is going on. Now, personally, I think we're gonna see a lot more inflation this year before we see deflation. Because remember, conflict is an inflationary pressure because it encourages government spending. And government spending means more inflation. And we can see this play out right here. Take a look at these commodity price indexes from food, metal, fuel. Everything is either at an all-time high or coming close to it. So that's where we are in the markets. Everything looks scary, and now more than ever, I want to share with you what has historically happened during times like this because I think it's super important. I've shared this one before in my videos, but I feel it's important again because I know YouTube doesn't always recommend all of my videos and not everyone watches all of my videos. But this is a reminder about what happens to the stock market during a recession, which some people think is going to happen at some point. Now, most people think recession means, people are about to lose money in the stock market, but that is not always what happens. A recession is not the same as a bear market. In other words, you can have a recession where the economy shrinks, but the stock market still makes money for people. It's completely counterintuitive. This is directly from Russell Investments research. Between 1869 to 2018, we've had roughly 30 recessions. Now, of those 30, 16 of them had a positive stock market return with an average return of 9.8%, even though the GDP, in other words, the economy, shrank on average 3%. So it doesn't make sense, but sometimes that's what happens. The other 14 recessions where the stock market went down, those lasted an average of 18 months with an average loss of 14.2%. Now, this just means that if you were to try to time the market when there's a recession, it's a 50-50 chance. It's like flipping a coin, and maybe you'll make money, but maybe you won't. But one thing is true. If you sell everything and you withdraw your money out of the market, you will lower your chances of making money. In other words, you will increase your chances of losing money because it becomes that much more difficult to time the market at its highest, because then you have to time the market buying back in, which is the second time, and that is almost impossible to do. Which is why for me, I'm not gonna try to time the market and I'm still gonna stay invested. As usual, have a wonderful rest of your day. Smash that like button, subscribe if you haven't already. Go grab your free stocks, your free Bitcoin. All the links are down below. My thoughts and prayers go out to the people of Ukraine. I sincerely hope this conflict resolves itself fast, and it's sad, but I think we'll get back to normal. In the meantime, I'll see you back here on Monday and Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.